they're not going to be complete because I don't know the laws in Cayman Islands or in Italy. But generally, with real estate investments, they're not huge tax things until you liquidate them. They're not huge like
Right.
tax burdens. You have to definitely check the local laws. And like one example, like in Spain, the country takes 20% of your gross rental income. So like there's the rules like that. Obviously, you have to check locally. Panama doesn't have anything like that. I think Panama, if you could own the property in your own name and operate it that way, that would be fine in Panama. I mean, that's how I have a little property there too, and I think it's in my wife's name. So, I mean,
Right.
you want to. I mean, I guess objective one is securely own the title of the property you're buying. That's like the most important thing, is make sure that you're the owner, you have it all on paper the right way in that country, and it's all secure and it's in your name and it's all good. So, and then you have to check out the local laws. In terms of like foreign companies or U.S. companies, you would use a foreign company or put it in your own name. That's what I would say. Probably to limit legal liability, you put it in the name of a company. And I think it works the same in other countries where you put it in the name of a company, and that company is like the legal responsible person.
Right.
In terms of the tax impact, I mean, there's different filings and stuff, but there's not going to be too much. There's going to be stuff you have to report, but you can basically elect, depending on the type of company, elect for it to be a pass-through, and then just report it like a regular U.S. rental and get a credit for taxes you pay. And that's like kind of the ideal situation. These aren't huge. Usually real estate are like tax preferred types of investments everywhere in the world. So there has to be some matching. Like if you have it in a company and they do depreciation different, technically you should recalculate the depreciation and do the books in the U.S. accounting when you report it on your Form 5471, which is a report of a foreign-owned, a U.S.-owned foreign corporation, as a Form 5471. So 5471.
5471.
It's quite comprehensive. But if you open up a company in that country, and it's like a corporation, like it pays its own taxes. Basically, if you open a company that pays taxes itself, and instead of you paying taxes, it's probably a corporation equivalent.
Right.
And that's the form you would file at the end of the year. And it's not like it shouldn't be. Like there's not that much different ways. Since you have to secure it legally, you probably have to put it in a corporation in that country. It's just how you have to do it, and then you just have to manage the filing correctly here. It shouldn't be a huge tax burden unless you're making a lot of money, in which case you have to pay your taxes. So, there's not that much. In terms of tax planning, I more recommend you set it up right to have the most secure legal possession and then review the taxes in that country. And there's not as much flexibility in terms of who's paying you from where, because it's, located in the country and it's getting paid for people that rent it, pay to use it. It's like pretty straightforward in terms of investments and planning.